Okay, so under supply analysis, okay, we will cover marginal returns and productivity, and then we will see break-even and shutdown analysis. And at the last, we will study understanding economies and diseconomies of scale. Now, again, I will like to start with basics part. Now, when it comes to production process, can you guys tell me what are the common inputs we put in production process? Common factors of production. To generate output, what are the factors of productions we need? Anyone from you like to try? Yes, one, we need raw material. Apart from raw material, what else we need? Okay, so common inputs we put in production process is land, labor, capital. So when you put these three inputs into a production process, what you will get output. Okay, land, labor, capital, we need to generate production. Okay, you will get output. Now output is also known as what? Output is also known as total product. Now three different types of product we will study. Okay, number one, total product. Number two, average product. And number three is marginal product. So first we will start with total product. Now what is total product? Total product basically means total output produced, you can say. Okay, this is your total product, total output produced. Take for example, a firm is manufacturing some chairs. Okay, in a month, let's say 500 units of chairs produced. So these 500 units of chairs is known as what? Total product. Now next is average product. Now let's say these 500 chairs are manufactured by sum of two labors. So now can you tell me what will be the average product? Okay, these 500 chairs are manufactured by sum of two labors. So what will be the average product per labor? Right, average product per labor will be 250. So this is how you can find out average product. Okay, total product divided by number of units of labor. Now next is marginal product. Now here the word marginal basically means what? The word marginal basically means additional. Amount of output, okay, that we produced by using one more unit of labor. Okay, by using one more unit of labor. Okay, in previous example, I told you these 500 chairs are prepared by sum of two labors. Now let's say we appointed one more labor. Now there are total three labors. And together all three, they are manufacturing, let's say 600 chairs. So what is the marginal product in this case? Yes, in this case, marginal product will be 100. So how to calculate marginal product? Okay, you need to remember the formula. Marginal product is equals to change in total product, okay, divided by change in quantity. So this is total product and this is quantity. What is the change in total product? From 500, now there are 600 units. So the change I can see is 100 divided by change in quantity. Earlier we have two labors, now we have total three labors. So change in quantity is also 1 unit. So 100 divided by 1, okay, you will get answer 100. Okay, so this is important formula for you to remember. Marginal product is equals to change in total product divided by change in quantity. Now, sometimes they may ask you to calculate marginal revenue. So what will be the formula for marginal revenue? Just you need to replace product with revenue. So tell me, what will be the formula for marginal revenue? Formula for marginal revenue will be change in total revenue divided by change in quantity. If you need to calculate marginal cost, the formula will be change in total cost divided by change in quantity. Okay, now try these questions. 19 and 20 you can try. Okay, once you are done, do let me know. Yes, 19th A is correct. Okay, what about 20? Okay, I will explain 20th question to you, Shabi. Okay, so what about others? 20th and 19th? Everyone got option A. Please confirm. Diksha, Parth, Yash, do you guys got option A? Okay, 19th is also A and 20th is also A. Okay, so let's see now how to do 20th question. An operator of Sky Resort is considering offering price reduction on weekday Sky passes. Normal price is 50 per day. 300 customers are expected to buy passes each day. So what you can do, you can find out the revenue. 50 into 300. Okay, revenue will be 15,000. So this is price, this is quantity, and this is your revenue. At discounted price of 40, 450 customers are expected to buy the passes. So this will give you revenue of 18,000. Okay. So we need to find out marginal revenue. What is the formula? Change in total revenue divided by change in quantity. So change in revenue is 3,000. Change in quantity is 150. So this will give you 20. So Diksha, is this correct? Is this clear to you? Okay, we will move to next part now. Okay, now in this slide, we will talk about total average and marginal product of labor. So we will prepare this entire table to understand these concepts. Now here L stands for number of units of labor. QL stands for total product. Okay, AP stands for average product and MP stands for marginal product. So how to calculate marginal product? Change in total product divided by change in quantity. Let's say if we are not producing anything, let's say we do not have any labors. So everything will be zero. Okay, total product, average product, marginal product, everything will be zero. Now let's say we appointed one labor and he start producing, 250 units of chairs, let's say. So now what will be the average product? Can you please compute what will be the average product? One labor is producing 250 units. So average product will be how much? How to calculate average product? Total product divided by number of units. So average product will be 250. What will be the marginal product? Okay, use this formula, change in total product divided by change in quantity. Change in total product from 0, it is 250 now. Change in quantity from 0 units, now we have 1 unit. So what will be the marginal product? Right, marginal product will also be 250. Now let's say we appointed one more labor. Now there are two labors working. Together they both are manufacturing, let's say 525 units. Please calculate average product and marginal product. Yes, so let's take average 263. And what will be the marginal product? Change in total product divided by change in quantity. Yes, so marginal product will be 275. Correct. Okay, now prepare this table. Okay, complete this table till 8th worker. I will give you the total product information. Okay, you guys complete this table in your notebooks till 8th labor. Okay, once you are done, do let me know. Okay, yes, for marginal, you apply this formula, change in total product divided by change in quantity. Okay, not from 250, from previous production you can find. So please confirm, are you guys getting these numbers? Shall we move further? Everyone getting these numbers? Okay, now we will summarize few important points from this entire table. Okay, so you can cross check yes and correct, if it is wrong for you. Now, first look at the marginal product. Okay, what is happening with the marginal product? Can you see initially from zero, marginal product became 250. Then from 250, it became 275. So up to second worker, okay, I will say marginal product is increasing up to second worker. So this is known as increasing marginal returns. Okay, as marginal product is increasing up to second worker, it is known as increasing marginal returns. Now look at what is happening from third worker. Marginal product is decreasing. From 275, it became how much? 225. Then from 225, it went down 150. From 150, it went down 100. From 100, it went down till 50. So till sixth worker, marginal product is now decreasing. So this is known as decreasing marginal returns or diminishing marginal returns, you can say. So this is law of diminishing. Okay, law of decreasing marginal returns or diminishing marginal returns. And after sixth worker, okay, marginal product went negative. Okay, so this means beyond a point, if you keep on adding more and more workers, law of decreasing marginal returns will kick in your production process. So up to second worker, everything is good. Okay, you are having increasing marginal returns. Every additional worker appointed is adding more in the production process. That's why it is known as increasing marginal returns. But from third worker onwards, every additional worker is adding less into a production process. So that's why we are having decreasing marginal returns. Now look at what is happening with the total product. When we have an increasing marginal returns, can someone tell me what is happening with the total product? Total product is increasing or decreasing? Right? Total product is increasing. At what rate it is increasing? It is increasing at an increasing rate. Why it is increasing at an increasing rate? Because every additional worker is adding more. First worker, he added how many units into a production process? 250. Second worker, he added how many units into a production process? 275. Okay, so total product is increasing at increasing rate because we have increasing marginal returns. Every additional worker is adding more. Now look at from third worker onward and tell me what is happening with the total product. Total product is still increasing or decreasing? Right. Now total product will increase at decreasing rate because every additional worker will add less into a production process. So your total product is going up, no doubt, but it is going up at a decreasing rate. From 525, it became how much? 750. Because next worker, he added only 225 units. From 750, it became 900 because he added only 150 units. From 900, 1000. Then from 1000, it became 1050. So whether we have an increasing marginal returns or decreasing marginal returns, total product will always increasing. Now tell me from sixth worker onwards, why marginal product is negative? After sixth worker, why marginal product is negative? After sixth worker, why marginal product is negative? Because your total product decreased, right? Total product went down. From 1050, it became 875. From 875, it became 600. So that's why your marginal product is negative because total product went down. Is this table clear to guys, to everyone? Okay, so now try to fill this. Okay, this is the summary now. Increase in output at increasing rate. So what will happen with the marginal product? Marginal product will increase or it will decrease. If output is increasing at increasing rate, marginal product will increase. If output is increasing at a decreasing rate, then marginal product will be, right, decreasing marginal product. If total output is decreasing, marginal product will be negative. Okay, now try to solve this. Sixteenth A is correct. Everyone got 16th A option. And 17th B is correct. Anyone need explanation? So in 16, Vivek, you need to find out number of workers resulting in highest level of average product. So prepare one column for average product. Okay, so here it will be 150. Here it will be 160. 510 divided by 3, this will be 170. Anyone need any explanation? 16th A, 17th B. Now next we will try to understand shapes of different curves in this diagram. So very first curve you can see it is AFC curve, which is in downward sloping direction. AFC stands for average fixed cost. Now look at the next curve, which is in blue, MC. MC stands for marginal cost. And just below marginal cost, we have a ATC curve. Look at the one which is in black, AVC, which is in U shape. So AVC stands for average variable cost. And just above average variable cost, we have ATC. Okay, average total cost. Now you won't be asked to draw the diagram in exam, but you might be asked to know the relation. Okay, how the shape of curve is looking like this. So to understand, reason behind these shapes, what we will do, we will prepare this table. Okay, just give me a minute. Okay, so we will prepare one very small table to understand the shapes of different curves. Okay. Now, before that, you need to understand in business, we have, two different types of cost. We can divide total cost in business into variable cost and fixed cost. Now, what is the meaning of variable cost? As the name is variable cost, so these costs will keep on changing. Variable cost has a direct relation with sales. If your sales increase by 10%, variable cost will also increase by 10%. If sales decrease by 5%, variable cost will also decrease by 5%. Okay, so variable cost has a direct relation with sales. Now, what about fixed cost? Fixed cost do not have any relation with sales. That's why the name is fixed. These costs will remain fixed. So whether your sales increase or your sales decrease, okay, these costs will stay fixed. Now, what can be the example of variable cost? Variable cost example can be raw material, right? Variable cost example can be wages. So if you produce more number of units, you need more raw material, you need more labors. So raw material and wages will increase. What can be the example of fixed cost? Fixed cost example can be rent. Okay, let's say you have hired a premises where you are doing a business. So every month you need to pay the fixed rent. So that will be the fixed cost. Salaries, at least in short run, we can classify salaries as a fixed cost. Every month you will pay fixed salary to your employees. Okay, so keep this in mind. Now we will prepare this table. Now let's say initially, if we are not producing anything, okay, zero quantity, can we avoid fixed cost or we cannot avoid fixed cost? What do you think? If our sales is zero, so there will be fixed cost or there won't be any fixed cost, right? There will be fixed cost. Correct. So let's say fixed cost is 3,000. What will be the average fixed cost? We cannot find out average fixed cost since we do not have any production, right? We cannot avoid. Total variable cost will be zero because sales 0. Variable cost will be 0. We cannot have any average variable cost. What will be the total cost now? Total cost will be 3000, fixed plus variable. Okay, we cannot have average total cost. We will not have marginal cost. Now let's say we started production, we produced 1 unit. Now whether we produce 1 unit, 2 units or 3 units, fixed cost will stay same. Okay, it will not change. Fixed cost will remain same, 3000. Now please find out average fixed cost. At first unit, what will be the average fixed cost? At second unit, what will be the average fixed cost? Right, 1500. At third unit, average fixed cost will be 1000. Now you can see as and when we are producing more and more units, your average fixed costs are going down. That's why in the diagram, you can see the slope of AFC curve is in downward direction. So which indicates as and when you produce more and more units, okay, your cost will come down because fixed cost will be divided into more number of units. So average fixed cost will go down. Okay, now let's say total variable cost is 1500 at first unit, 2250 at second unit, 3750 at third unit. From this information, calculate average variable cost. At first unit, it will be 1500. At second unit, what will be the AVC, average variable cost? Two two five zero divided by 2. Okay, this is how you can find out average, 1125. At third unit, what will be the AVC curve? AVC, average variable cost at third unit. At third unit, it will be 1250. So what is happening with AVC? See, from 1500, initially it went down 1125. And then again from 1125, it went up 1250. So that's why slope of AVC curve is U-shape. Okay, look at the diagram in black color. The slope of AVC curve is in U-shape because initially from 1500, it went down till 1125 and then again from 1125, it started increasing. So the slope is in U-shape. Okay, initially going down and again it is increasing. Okay, let's calculate now total cost. How you will calculate total cost? Total fixed cost plus total variable cost. Okay, this will give you total cost. So at first unit, it will be 4500. At second unit, it will be 5250. At third unit, it will be 6750. Now, can you calculate average total cost? Okay, one way you can calculate average total cost, you can sum up these two, average fixed cost, average variable cost. If you sum up these two, you will get average total cost. Right, so average total cost at first unit will be 4500. At second unit, it will be 2625. And at third unit, it will be 2250. Correct. Okay, so average total cost curve is combination of average fixed cost plus average variable cost. Average fixed cost curve has a downward sloping shape. Average variable cost has a U-shaped curve. So that's why because of these two combination, the slope of ATC is also looking like a U shape. Okay, so ATC curve is the combination of AFC curve and AVC curve. Now please calculate marginal cost. What formula you will apply for marginal cost? Change in total cost divided by change in quantity. Change in total cost divided by change in quantity. Tell me, what will be the marginal cost? Yes, 1500 at first unit. At second unit, it will be how much? 750. At third unit, it will be again 1500. So what is happening with marginal cost? Initially, marginal cost came down, right, from 1500 till 750. And again, it bounced back till 1500. Okay, the slope of MC curve is looking like a U shape, right? But on upside, you can see this is very steep slope. Okay, on upside, the slope is very steep. Okay, now next point which you need to remember is the point at which AVC curve intersect MC curve. Okay, the point at which AVC curve intersect marginal cost curve. So that point is called as what? That point is called as minimum point. Okay, let me show you in the diagram. The point at which AVC curve intersect MC curve. AVC curve is in black color, MC curve is in blue color. So together they both are intersecting here. So this point is called as what? Minimum point. Okay, now let's understand what is the meaning of this minimum point. Okay, now I will divide this diagram into two parts. See. Now look at on the left side of minimum point. Tell me what is the relation between AVC curve and marginal cost curve. Which one is greater? Which one is smaller? Right? AVC is more than marginal cost. Correct. AVC curve is greater than marginal cost curve. This means if you produce, more and more units, your marginal cost will come down. And your marginal cost will pull your average variable cost. Cost to produce every extra units is going down. That's why you can see the slope of marginal cost is in down direction initially. Because of this, your average variable cost is also coming down. But what is happening with these two curves on the right side of intersection? On the right side of minimum point, you can see marginal cost is now more than average variable cost. So this means if you continue your production after minimum point, then cost to produce every extra unit will be higher, because of which your average variable cost will also pull up. So we should restrict our production up to minimum point. Okay, up to minimum point, your marginal cost is less than average variable cost. And after minimum point, marginal cost is more than average variable cost. Cost to produce every extra unit will be higher. Okay, after minimum point. So this will lead to diminishing marginal returns in your production process. Okay, try this now. These three questions you can try: 21, 22, 23. Yes, 21st A is correct. 22nd C is correct. Yes, 23rd C is correct. So everyone got correct answers A, C, C. Okay, we will move to next part now. Okay, now next part, we need to understand about break-even and shutdown analysis. Now, can someone tell me what is the meaning of break-even? The word break-even means what? Correct. No profit, no loss. So I can say at break-even, total revenue is equal to total cost. Right? Firm is neither making any profit nor making any losses. So operating at a break-even. And what about shutdown? When to shut down a firm? When to shut down a business? Correct. When total cost is more than revenue. When firm is making losses. When profit is below zero, you can shut down. Now here you need to understand shutdown decision in long run. Okay, what should be the shutdown decision in long run? And what should be the shutdown decision in short run? Okay, that we will discuss. Now, before that, I will cover the basics part first. Now, first, we will discuss the different types of profit we have in economics. So in economics, you will find three different types of profit. Okay, very first one is economic profit. Second is accounting profit. Third one is normal profit. Now here, economic profit is also known as abnormal profit. Or you can call this as a supernormal profit. Okay, so one is normal profit and other one is abnormal profit or economic profit. And third one is accounting profit. Accounting profit means your accounts profit. Okay, profit after tax, net income. Okay, that is known as the accounting profit. So this accounting profit you will get from income statement. So we will discuss the income statement in FSA. Okay, there you will learn how to calculate accounting profit. So there is a proper format which you need to follow to come up with profit after tax or net income. Okay, so we will discuss these three types of profit with the help of example. Let's say we have started the business and we invested, let's say, a capital of rupees 1 lakh in the business. And let's say required rate of return is at least 10%. Okay, at least 10% we want to make. Why 10%? You can think in this way. Let's say you do not have 1 lakh. What you have done, you have borrowed this 1 lakh at 10% rate of interest. Now, minimum you have to earn 10%. Otherwise, you will be in losses. Because 10% is the only interest which you need to pay. So that's why, minimum required rate of return for you is 10%. So we will call this 10% as opportunity cost. Okay, and what is opportunity cost? We will discuss in coming slide in detail. Now let's say total revenue we made in first year is, let's say, 2 lakh rupees. From total revenue, what we will do? We will deduct accounting cost. Let's say your accounting costs are 1,90,000. So 2 lakh minus 1,90,000. Okay, 10,000 will be your accounting profit. Okay, total revenue 2 lakh. Accounting cost 1,90,000. Accounting profit will be 10,000. So this is your profit after tax. Now from profit after tax, what we need to do? We need to adjust opportunity cost. Okay, so please calculate what will be the opportunity cost. 10% of 1 lakh. So what it will be? %10 of 1 lakh, it will be how much? 10,000. So when you adjust opportunity cost from accounting profit, okay, you will get what? You will get economic profit. So in this case, your economic profit is coming 0. Okay, economic profit is what? Economic profit is 0. Now, what is opportunity cost? You can think in this way. Let's say you already have 1 lakh with you and you have two choices. Either to invest this 1 lakh in bank FD. Let's say from bank FD, you can easily make 10%. Or second option you have, you can start a business. Out of these two options, what you decided? You decided you will start a business. You will invest 1 lakh to start a business. You will not invest in bank FD. This means now you need to give up this 10% return. Okay, you cannot earn 10% interest anymore because you have now decided to start a business. So this 10% which you are giving up to start a business, this 10% is known as what? Opportunity cost. Okay, cost of giving up one option instead of another. That is your opportunity cost. Okay, cost of giving up one option, that is known as an opportunity cost. So that's why this cost we are doing adjustment here. From accounting profit, you need to adjust opportunity cost. So economic profit is 0. So you are not making any supernormal profit. So how to calculate economic profit? Economic profit formula will be total revenue minus total economic cost. Now look at this entire table and tell me what will be the formula for economic cost? What will be the formula for economic cost? Formula for economic cost. Accounting cost plus opportunity cost. Okay, this formula you can apply for economic cost. Accounting cost plus opportunity cost. Okay, here you can read. Accounting profit is known as what? Accounting profit is known as net profit. Okay, net income, net earnings. This we will learn in FSA, how to calculate. So revenue minus accounting cost is what? Accounting profit. Now this accounting cost is known as explicit cost. Do you guys know the meaning of word explicit? Accounting cost are known as explicit cost. Explicit means which is given to you, directly given to you. And opposite of explicit is implicit. Okay, implicit means directly not given to us. We need to do the adjustment. Okay, like opportunity cost. opportunity cost is a implicit cost. Okay, we are doing this adjustment from accounting profit. Okay, we are doing this adjustment of opportunity cost from accounting profit. So this opportunity cost is implicit and accounting cost is explicit. Okay, this I've told you, economic profit is also known as abnormal profit or supernormal profit. How to calculate economic profit? Revenue minus economic cost. And how to calculate economic cost? Accounting cost plus implicit opportunity cost. And here is the meaning of opportunity cost. Opportunity cost of any particular decision refers to benefit foregone by not implementing the next best alternative. So in our example, what was the benefit we have foregone? Interest rate, right? Bank FD rate. So that was the benefit we foregone. So that's why, 10% became our cost. Next, you need to understand about normal profit. See, normal profit is nothing but, you can say, opportunity cost. Okay, normal profit is equal to opportunity cost. Another name of opportunity cost is normal profit. Okay. So I will give you one more example to explain opportunity cost. Okay, you can think like this. Let's say after completing CFA, you have two choices. Either you can go for a job, and let's say it is expected you will earn 1 lakh rupees per month, or you can start your own startup. Okay, these are the two options available to you. Now, out of these two options, what you decided, you will go for a startup. Okay, you will not go for a job. You will start your own business. So what is the opportunity cost to start your own business? Tell me, what will be the opportunity cost, guys, here to start your own business? Be fast, please reply. What will be the opportunity cost to start your own business? Opportunity cost to start your own startup will be 1 lakh rupees per month, because you are giving up job to start a business. So you need to forgive this 1 lakh rupees now. So this 1 lakh will turn your cost. Okay, this is your opportunity cost. Yes, salary. Now let's say in first year of business, or let's say in first month of business, you made 60,000 profit. Or let's say you made 1 lakh rupees profit, for example. So what is your economic profit now? In first 1 month of business, let's say you made a profit of 1 lakh. So this 1 lakh is your accounting profit. I am asking, what will be your economic profit now? What will be your economic profit? Okay, accounting profit is 1 lakh. What will be your economic profit? To calculate economic profit, what you will do? You will adjust opportunity cost. You will subtract opportunity cost. So tell me, what is your opportunity cost? Your opportunity cost is also 1 lakh. So what is your economic profit? Your economic profit is 0. This means you are not making abnormal profit, but you are making normal profit. See, by doing job also, how much you could have made? 1 lakh. By starting business, how much you are making? You are making 1 lakh only. So this is called as a normal profit. By doing job also, you could have made 1 lakh. So you are making normal profit, but you are not making abnormal profit. You are not making anything over and above 1 lakh. Okay, anything over and above 1 lakh will be your abnormal profit, super normal profit. Okay, so that's why opportunity cost is also known as what? Opportunity cost is also known as normal profit. You are earning normal profit in this case.
I have a question here. Like, this accounting profit minus opportunity cost. Like 2 slides earlier, you were telling us that opportunity here, that economic cost. We were talking about economic cost two slides earlier, wherein the formula was accounting cost plus opportunity cost. Here we are talking about economic profit. I'm just confused between these two things.
Yes. So economic, when you subtract economic cost, then you will get economic profit.
Okay.
Look at this bottom line. This bottom line is economic profit. To calculate economic profit, we are deducting 2 types of cost. See, one is accounting cost and one is opportunity cost. These 2 costs we are subtracting.
Sure. Okay.
Okay. So in this example, I have directly given you accounting profit. And opportunity cost you know already. So you can easily calculate economic profit.
Yeah, got it now. I was confused.
Now let's say you are making 1,30,000 in first 1 month of business. Okay, now tell me what will be your normal profit and what will be your economic profit. Okay, this is your accounting profit. 1,30,000 you made in first month of business. Okay, calculate economic profit. Right, 1 lakh normal profit. So you are making now 30,000 extra over and above 1 lakh. That will be your economic profit. Okay, abnormal profit. So basically what we are doing, we are dividing accounting profit into 2 parts. Okay, one is normal profit and one is economic profit. And your normal profit is nothing but opportunity cost. Let's say you made 60,000 in first month of business. So now tell me, what is your normal profit? What is your economic profit? Okay, 60,000 is your accounting profit. Okay, do the calculations. Okay, normal profit is fixed. It is 1 lakh in our example. So what will be the economic profit now? Yes. So here it will be minus 40,000 loss. Okay, forget abnormal profit. We are not making even normal profit in this case. Okay, 40,000 loss. So your economic profit is negative 40,000. Okay, now this is the summary table. Now fill this. If accounting profit, normal profit, both are equal, tell me what will be the economic profit? Economic profit will be 0, positive, negative. What do you think? Right? Economic profit will be 0. If accounting profit is more than normal profit, economic profit will be, right? It will be positive. If accounting profit is less than normal profit, economic profit will be negative. Okay, now next we will discuss shutdown decision. But before that, can we take some break? 5 minutes break can we take? Is this fine? Okay, then we will continue after 5 minutes. Okay, thank you. Okay, so now we are discussing shutdown decision both in long run and in short run. So these 3 situations I have prepared. Situation 1, 2, and 3. Let's say for situation 1, okay, revenue is 25,000. Variable cost is, let's say, 20,000. and fixed cost is 10,000. Now this fixed cost will be same for all three equations, 1, 2, and 3. That's why the name is fixed cost. Okay, it will not change. So just analyze this equation 1 and tell me what should be the decision. Firm should continue to operate or firm should shut down. What do you think? Revenue 25, variable cost 20, and fixed cost is 10,000. Right? So you might feel that firm should shut down the business because total cost is more than revenue. But we will try to analyze this equation in detail. See, if we continue to operate, okay, we are making 5,000 profit here because revenue is 25, variable cost is 20. We are making 5,000 profit. Fixed cost is 10,000. Out of 10,000, we can easily pay 5,000. So how much is the loss? Loss is 5,000. If you continue to operate, you are making loss of 5,000. Now, take for example, you decided to shut down the business. If you shut down the business, what will happen? Revenue 0, variable cost 0, but you cannot avoid fixed cost, right? So if you shut down, the loss will be 10,000. So now tell me which is the best situation. We should continue to operate or we should shut down? Right? We will continue to operate in this case. So what will be the decision in short run? I will say in short run, firm continue to operate. And in long run, firm should shut down the business. Okay, long run, firm can exit the business. Firm can change the line of business. Now, what is the meaning of long run here? See, once you cover all your entire fixed cost, okay, at that time you can exit from the business. Till the time you are not recovering your fixed cost, you continue to operate. Once you recovered all fixed cost, okay, do not renew it. You can think like this. This 10,000 is nothing but, let's say this is your monthly rent payment and you paid 12 months of rent in advance. So that's why there is no point to shut down the business in between because this fixed cost has already occurred. After 12 months, okay, when rent will be due for renewal, at that time you do not renew it. At that time you exit from the business. Okay, so short run basically means it is a time period till the time you recover your fixed cost. Once your entire fixed costs are recovered, then that time period will be called as long run. Now, second situation, let's say revenue 18,000, variable cost 20,000, fixed cost 10,000. Now, what firm should do? Continue to operate or shut down? Correct. Okay, this time we will shut down because forget fixed cost, we are not recovering variable cost also. So here by continue to operate, you are making 2,000 loss. Fixed cost is another loss, 10,000. So total loss is 12,000 if you continue to operate. If you shut down, okay, again, revenue 0, variable cost 0. So your total loss will be 10,000 in that case. So the best decision is shut down. Okay, and exit in long run. Third situation, let's say revenue is 35,000. Variable cost 22,000, fixed cost 10,000. Now, what should be the decision, both in long run as well as in short run? What firm should do? Revenue 35, variable cost 22, fixed cost 10,000. Okay, revenue is greater than total cost. So firm should continue to operate both in long run as well as in short run. Okay. So we will prepare this table now. When your total revenue is greater than total cost, okay, firm should continue to operate. There is no problem. Total revenue is greater than or equal to total variable cost, but total revenue is less than total cost. Then firm should continue to operate in short run, exit in long run. When total revenue is less than total cost, okay, firm should shut down and exit in long run. Okay, third situation is total revenue is less than total variable cost. Okay, try this now. 30, 31, 32. Okay, for 35, it is B. For 36, B. Sorry, my mistake. Just a minute. Let me check again. Yeah, for 30, it is B. Okay, 31 C and 32 is B. Sorry. Okay, now last part is pending. Okay, economies and diseconomies of scale. Now, what is the meaning of economies of scale? See, if you are producing more units and at the same time your cost is also going down, then this phenomena is known as economies of scale. Okay, you are producing more units at a lower cost, at a lesser cost. Every unit which you are producing at a lesser cost. So this is known as the economies of scale. And diseconomies of scale, you are producing more units, but cost is also going up. So this is diseconomies of scale. Okay, look at the diagram. Look at the curve at the center. This curve is known as LRAC curve, long run average cost curve. And how's the shape of curve? U shape. On x-axis, I have taken the quantity. On y-axis, I have taken the cost. So what is happening with the curve initially? Okay, since the shape is U curve, U shape. So what is happening with the curve initially? Initially, the slope is negative. The slope is going down. So what this indicates, if slope is going down, what this indicates? This indicates if you produce more and more units, your cost will go down. That's why the slope of curve is downward direction. So this represent economies of scale. Okay, this represent economies of scale. You are producing more units, but cost is going down. And what is happening afterwards? the slope is going now in up direction. This means if you continue to produce more and more units, what will happen? Your cost will also increase. So diseconomies of scale will kick in your business. And what is at the center? Minimum efficient scale. Just like we have done minimum point. So this is minimum efficient scale. This means you should restrict your production up to minimum efficient scale. Do not go beyond minimum efficient scale, because beyond minimum efficient scale, the slope of curve is in up direction. So diseconomies of scale will kick in your production process. Now tell me, you are operating somewhere here on the left side of minimum efficient scale. Look at the red dot. So what you will do? You will increase the production or you will decrease the production. You are operating on the left side of minimum efficient scale. Right? We will increase the production. And if we are operating at right side of minimum efficient scale. Okay, look at this blue dot now. So here what we will do, we will decrease the production, right? Now, what can be the reasons for economies and diseconomies of scale? So factors contributing economies of scale I have written. Okay, number one, increase in output is greater than increase in input. So that's why your quantity is going up, cost is going down, because increase in output is greater than increase in input. Second reason is specialization. Maybe you have specialized labors, skilled labors. That's why the cost is going down. Maybe you are using more expensive, more efficient equipments in your production process. At your workplace, there are lower wastages, hence lower cost. Better use of market information. So many businesses are having raw material which is based on commodity. Take, for example, paint business. Okay, in paint business, the raw material is crude oil. To manufacture paint, okay, the primary raw material is crude oil. And crude oil is a very volatile commodity. Right. So if crude oil prices will go up, what will happen? Your cost of production will increase. If crude oil prices will come down, your cost of production will go down. If cost of production will go down, profit margins will improve. Now, let's say you are working as a purchase manager in one of the paint company, let's say Asian Paints. And you know very well in coming time, crude oil prices will go down. So what you will do, you will wait for some time. You will not place order for crude oil, right? You will not store inventory because you expect prices will go down. So once prices will go down, then only you will place the order. So this means what you are doing, you are basically using market information in a better way. Okay, which will lead to economies of scale. Sixth one is volume discounts from suppliers. So if you buy quantity or raw material in bulk, okay, suppliers can give you volume discount. So volume discount will decrease your cost, right? It will increase your profit margin. So this will result in economies of scale. And what can be the factors for diseconomies of scale? Okay, completely opposite now. Increase in output is less than increase in input. Okay, quantity is going up, but at the same time, cost is also going up. Too large to manage efficiently. So when you have too many labors in a production process, okay, diseconomies of scale, diminishing marginal returns will kick in. So this will result into diseconomies of scale. Okay, duplication, higher labor cost, higher resource cost. So all these will increase your cost of production. If cost of production increase, profit margin will decrease. Okay, any confusion in this? Is this clear? Economies and diseconomies of scale. Okay, now try last three questions you can try. Yes, 35B is correct. 36B is correct. Okay, Diksha, what is your answer for 37? Okay, A, B, both are incorrect. C is correct for 37. See what it is written. A firm is operating beyond minimum efficient scale. So this is the diagram U shape. Okay, this is the efficient scale. Beyond means towards the right side, somewhere here. So what you will do now, if you are operating here beyond minimum efficient scale, so what will be the course of action? Right, we will decrease the level of production because this is diseconomies of scale. So we will decrease the production up to minimum efficient scale. Okay. Okay, so we have completed this reading, topics and demand and supply. Okay, this was prerequisite part. Okay, now next session we will meet on Friday. Okay. Yeah, 37 Diksha, I already explained. Here it is mentioned beyond minimum efficient scale. This point we have discussed, if you remember. Beyond minimum efficient scale, look at the blue dot. Okay, on the right side. You are operating somewhere here on the blue dot on right side, beyond minimum efficient scale. So what you will do? You will increase the production further or you will decrease? Right? You will decrease the production towards minimum efficient scale. So that was your question number 37. Okay, so shall we wind up here? We will meet again on Friday with a new session. Okay, new topic.
Good evening, sir.
Yes, good evening. Yeah.
Sir, I have not received the earlier recorded lectures.
Yeah, so I will, drop all links in the WhatsApp group now.
Okay, okay.
Yeah. So if you click on those links, you will get all the recordings.
Okay, fine. No issue. Thank you.
Thank you. Okay. Sure. Thank you, guys. So we will meet on Friday with new topic. Thank you. Sure.